I will love to take a step back. When we created our strategy 12, 13 years ago, we said that one of the success factors to investing in private equity is to be a constant investor in private equity. So it's impossible to time the market, because a private equity firm has, or private equity fund has 4 or 5 years of investment period, and no one could foresee what's happening the next 4 or 5 years. So I think the thing is to try to pick managers that you think could adapt, not only on the present economic situation, but also some other economic situations, even if it will be a downturn economy or a very, I would say, bull situation as well. So they should be adaptable and they should have a strategy that are applicable for different type of economic environments. So I think that's number one, and I think we have picked a number of those, probably not all, but majority has fallen into that sector, I think, or to that range. I think for future, I think what we have seen for private equity managers the last 12, 15 years is that their toolbox has been so much bigger. They are using so much more tools today than they did in the late 90s. Then it was a lot of financial engineering, I would say. Now they have so much more operational experiences and sector knowledge into the teams. So I think that's a development that will continue. So the private equity managers will adding more and more strategical value to their portfolio companies. And I think that step by step will continue. But that's also a need for those managers which are out there then to have a critical size, to be able to afford to have this kind of broad knowledge experience in-house. And I think that's something that we will see continue. They have more, I would say, you have a number of very big funds today, or very big firms that have a number of funds. And I think that will continue. You will also see an increase number of funds, I think, which will have a more narrow investment strategy. Today, there are a number of those that are generalists in the buyout sector. Buyouts, North Europe, for example. I think they will be more narrowed into specific sectors rather than to be generalists. There will be some generalists left, for sure, but I think that's the path that will happen. And I think also one thing that we are seeing now, which I think will increase as well, is to be more flexible where to invest on the balance sheet. If you do equity investments or debt investments, I think that will be more connected to each other in the future, how to finance a company to let it grow, develop that company. I think that's something that we will see more of in the future as well. First of all managers think they are top quartile. So that's the number one. Then if we take it very seriously and take it from the beginning, what we have done this year is that we have done a deep dive in researching returns from private equity since late 80s up to now. We have done that from a global perspective with a global private equity portfolio. And we have done it measuring TVR, even if it's impossible to measure TVR. We have done it in public market equivalent, and when we have made it to IRR spread. And we have done it up and down, back and forth, and found out that in the long term, private equity is outperforming, in average, is outperforming public market indices. It could be a normal index, it could be a value index, it could be a small and mid-cap index. You can leverage the index, and you could think about all type of sector rotations. We still think that private equity is outperforming the public market. So private equity is an asset class or a type of assets that you think should make a lot of sense in your portfolios. Steve Kaplan, which is a professor in Chicago, had made the same type of study, maybe probably more thorough than we have done in our fund, but on our scientific angle, and he found out exactly the same thing in US buyouts. And US buyouts is almost 60% of the total market. So I think that it makes a lot of sense that we have come to the same conclusions. So by that, I'm saying that you are not forced to pick top quartile managers to outperform the listed markets. I think it's rather a secret of trying to avoid those ones that are performing really bad. And that's also something that is quite hard to do. We were listening yesterday to a presentation of Tim Jenkins, which is a professor on Oxford, and the persistence in private equity has come down quite dramatically. So if you have a top quartile manager today, the likelihood that he or that fund should perform very good in the next round as well in the next fund has normally been or historically been very high. Today it's not more than a quarter, more or less. So you couldn't predict future returns by picking managers which are good today. So I think it's a lot of things that should be taken into account into assessment. And I mentioned earlier, for a minute ago, about strategy. Does the manager have a strategy that is applicable for today's environment or probably the future's environment as well? Does the manager have a team that makes sense in that type of strategy? Does the manager have incentive schemes in the team to keep people tied to the group so they are not leaving? So there is a number of things that should be taken into account. And I think if you do that, and in the end, what you should also do is to put a lot of trust into the manager, because you give him the money, then you're waiting 10 years, and then you hope you get more money back than you give the manager the first year. So if you take all of these things together, and it's a combination, in fact, between brain and stomach. You should have a lot of green dots on everything that you think are important, but you should, in the end, feel, this is a manager that I could trust. I think the manager will deliver good returns to me, and that's a good combination, I would say, to make an investment. I'm not sure that you will pick the top quartile managers, but I think you will probably pick managers which are above average. So that's a little bit, I think, the secret sauce in private equity. I assume that a number of those very big PE houses, they are public companies, more or less, or will become public companies. And when there are, I will say, a founder that is CEO, will retire, the company as such will probably recruit maybe an external new CEO, which have another background, other experiences. So I think they will move probably closer to be even more multi-asset managers, and maybe even more like the investment banks where they historically were. So I think so they will be more generalists in the financial sector, and then you will have new people coming up maybe and become the new big PE houses. You never know.